Hey.
Hello, everybody. Last but not least, Husnu.
Thank you very much, everyone, and thanks for your patience. I hope I'm not going to bore you further. So this is joint work with Larry and Armin.
Was a comment on the previous paper.
I'm a foreigner, so this is like a language. I want to say I don't want to tire you further. Sorry. This is joint work with Larry and Armin. And we are going to do something that Laura told us not to do. We are going to combine all the emerging markets to find a common explanation.
No, what I meant is we should not be asked to do that. Evidence from a good country, that should be enough.
Okay. So the topic is financial dollarization. So we are going to ask whether this is an efficient risk arrangement or a prescription for disaster. So let's take a step back. What is financial dollarization? We are going to mean two things. We are going to talk about credit dollarization, where firms borrow in a foreign currency. So we call this dollars, but it could be euros or Swiss franc, but mostly dollars. And deposit dollarization, households and firms saving dollars. And what does the literature say about dollarization? Well, there are a lot of papers on dollarization as a source of international risk sharing, and we also had a bunch of papers. Like emerging markets, they save a lot as reserves so that they could use this in bad times. So this could be related to what Gorin Chazray and Govio say, exorbitant privilege, exorbitant duty type of. And then another set of papers talk about dollarization as a source of financial fragility. Yes, there's an international aspect of it, but there's also an international aspect of it, because when a lot of saving and borrowing is done in dollars or in another foreign currency, there are mismatches which could lead to a disaster. Well, we are going to go for a third explanation, and we are going to argue that financial dollarization is actually an intranational insurance arrangement. What do we mean by this? We mean that a lot of residents are saving in dollars and a lot of residents are borrowing in dollars, so that it's a device for one group of people in the country to insure others within the same country. We are going to provide evidence that intranational flows are actually larger than international flows for certain emerging market economies. And then we find no evidence in this work that dollarization is associated with frequency or severity of banking crisis. And then we don't find large balance sheet effects in the corporate sector either. And now we are going to build a simple model to sort of explain what is going on in the data. So we are going to first start with a large data set that we construct.
Can you be clear about this? Can you go back? When somebody has you have a dollar debt, okay, one is exposed, one's going to win from a situation, the other one's going to lose. So, there's going to be there is some insurance there.
Yeah,
no?
Yeah, absolutely, absolutely.
But one is, one is winners and losers.
Yeah. They're winners and losers, and that is insurance. That's okay. But if they are like super large, you could imagine, like for example, you could imagine if there are like super large financial frictions, like the losers could lose so much that it could lead to a disaster.
I see. So you're saying that on the aggregate, the insurance decides that at the end, it's a good thing.
It looks like these are not very important. We don't find any evidence of this related to dollarization. Also, we are going to look at firm balance sheet. We don't find large balance sheet effect. So we are going to start with a large set of countries, determinants of dollarization, also later on determinants of banking crisis. Then we are going to narrow down a little bit and to have a little bit disaggregated data in 16 small open economies, emerging markets. So we are going to look at who is borrowing and lending in dollars and how much. And then we are going to narrow down a little bit more. For Peru and Armenia, we have firm level data to look at what happens to balance sheets following depreciations.
Well, as you go down, I know very little about Armenia, I'm so sorry, but Peru is particularly a country that is very internally dollarized. People do save in dollars, which is not the case in Chile, Brazil, Mexico.
True, true. And actually, a lot of emerging markets, you're not allowed to actually save in dollars. Like I know there are like large controls. We also see that in the
Yeah.
paper. Yeah.
No, in Brazil it's weird. I mean, people need to be. It has to be settled in reales, but you can have index accounts. So your account can be indexed to the exchange rate, but it has to be settled in reales, and immediately you can go and buy the dollar.
We're looking at, for example, for Mexico, we're looking at the IMF, so do you have to be like living close to American border to open an account and things like that?
More than that. You can have dollar.
IMF, I mean, we can talk about it. We can talk about it. So our motivation is going to be that we are going to argue that countries with counter-cyclical exchange rate is going to have higher dollarization. What do I mean by counter-cyclical exchange rate? So in countries, whenever exchange rate depreciates, you could see a recession. That's counter-cyclical exchange rate. In those countries, you see high dollarization. So in Latin America, you tend to see that a lot. In Turkey, you tend to see that a lot. But in advanced economies, I mean, you don't see that. How are we going to measure co-movement? So for every country, we are going to run the following regression. We are going to run the change in real GDP on change in S is the nominal dollar exchange rate divided by CPI. So change in the purchasing power of dollars. So we are going to run this for every country, and both left-hand side and right-hand side are scaled by their standard deviations so that we can talk about something standard. And it turns out that this rho is the correlation coefficient, which is great because this is direction-free, so we are not talking about any causality, like whether this causes that or that causes that. You can switch left-hand side and right-hand side. You are going to find the same coefficients. And the interpretation is going to be that, like how many standard deviation movement in GDP is associated with how many standard deviation movement one standard deviation movement in the purchasing power of dollars. So what we are going to do now is to regress this dollarization, average dollarization, on this correlation coefficient that we find for every country. And it turns out that we have a highly significant negative coefficient, which means that when this correlation is negative, you tend to see high dollarization. So of course, I mean, inflation is also another factor in explaining dollarization, significant, but doesn't even change the coefficient much. And people told us about adding commodity export, maybe inequality could matter, reserves could matter. Institutions, it seems to matter a little bit. Central bank independence doesn't matter. External debt matters a little bit. But overall, and the coefficient of our correlation is highly stable.
Can you repeat how you measure dollarization?
Dollarization is the amount of foreign currency savings inside local banking system as a share of total savings in the local banking system.
Is the share of deposits in dollars?
Yes.
But on the measure, Argentina will be dollarized.
Yeah, no, it won't be dollarized.
But it's very dollarized.
We agree. So there could be a little unofficial dollarization. This is something we are unable to capture.
So the measure is a mixture of capital controls and dollarization.
You could say, yeah.
Because if you don't allow, so Argentina, where people have it under the mattress.
Yeah,
you just
this
don't
is
put it
something we don't observe. Yeah. So our interpretation is that this negative co-movement between GDP and exchange rate leads to high dollarization. It was part of my PhD thesis. And in these economies where you observe this high and negative covariance, means that currency depreciates in a recession. So dollar returns jump, exactly the moment your income is low. So it has an insurance property. It's precious because dollars give you income when your overall income is low. So one question will be, I mean, we are agnostic how this co-movement is driven. And the literature talks about, could be disturbance to export demand. It could be related to dollar invoicing. It could be related to global financial cycle. It can also be related to government irresponsibility. Maybe in a recession, government just prints more money. You get inflation, depreciation. But this is only correlation, so it could be, the reverse causality could also be important. So it could be that fear of financial crises makes people buy dollars, and then the resulting currency mismatch creates the financial crisis. So that's the Boccola-Lorenzano story. And we are going to show some evidence against this hypothesis. And then now I would like to move to who is borrowing and who is lending. I mean, as Laura we were talking yesterday, it's not the banks. We look at IMF financial soundness indicators, 115 countries. They have net FX exposure per country, 0, basically. Yeah. A little mismatch, and actually we were really surprised. The largest amount of mismatch looks like it's Israel, but it turns out that they don't report the derivatives they are using. And so what we do then is to collect data from 16 emerging market economies. These are Peru, Turkey, Hungary, Albania, Ukraine, Russia. There's Mozambique, and several others. So we look at how much households hold dollar deposits as a share of total dollar deposits. So firms can also hold dollar deposits. But it looks like around 60% of dollar deposits are held by households, so the majority, but not the overwhelming majority. So firms also hold a lot of dollars. So we look at firm borrowing from local banks divided by firm borrowing from everywhere. Here, everywhere denotes bonds issued in international markets that we get data from BIS, if available. In these economies, it looks like they borrow from bond markets, but not that much. Most of the dollars are borrowed from local banking system. Households also borrow. So this is household dollar borrowing from banks as a share of total dollar deposits. So firms and households, they make a deposit in the local banking system, and around 20% is borrowed by households. And total dollar borrowing by firms, this also includes international security issuances, divided by total dollar deposit is around 90%. So when you sum this, you get a number very close to 1, which tells us that the amount of dollar savings by private residents in a typical emerging market is roughly equal to the amount of corporate and household dollar borrowing. So that is why we argue that it's mostly intranational. What about the government? We isolate the government here, but we look at government position in the paper. Governments have been borrowing less in dollars, and you look at the time series, and they are actually accumulating more reserves. So when you look at the net public position, it's slightly positive. For some countries, it's highly positive.
One question. So, for example, in Chile, a lot of the deposits that show up in the statements that are in dollars is actually that the multinational borrowing dollars is depositing in the local bank.
Yeah.
Would that matter for you?
Well, probably not. If they also would like to, a lot of firms also would like to use these dollars as a hedge against.
Yeah, it's usually when you get that loan, it gets deposited, and so it gets. So you have an asset and liability.
Yeah. So then we are going to formally talk about this intranational versus international. So this follows Larry's paper with Cherry on commodities. So we are going to look at the minimum of dollar deposits and dollar loans. So the minimum would be like Of course, money is fungible. Like, we don't know who is lending to whom exactly, but the minimum is we interpret as the intermediation between residents, between lenders and borrowers. As a share of GDP, international insurance would be the difference as a share of, again, GDP. So it could be positive or negative, but the difference would be the amount of intermediation, and then we are going to divide them. So let me first show you insider and across. So insider is the within country intermediation. I mean, it's sorry?
Can you go back one? So the difference is international, right?
So there are savers in dollars and there are borrowers in dollars. So the difference must be borrowed from abroad. So it starts around an average 8% of GDP. Now it's around, insider is around 11% of GDP, and across is around 5% of GDP. This is household borrowing in Eastern Europe mostly. And when we divide them, so we find that this across, like outsiders divided by insider, the median is almost always below 1. Now even the upper quartile is below 1. So it looks like mostly dollar borrowing is covered by dollar savings by residents. So then you should ask me, where are the foreigners? I mean, don't they invest in emerging markets? So we don't exactly see how much foreigners invest in dollars versus borrowing dollars, but Benetrix et al. Paper, they have for several economies, they have this. They have foreigner assets in foreign currency and foreigner liabilities in foreign currency. So we merge, for a couple countries, we merge their data with our data. So this is our measure of how much dollar saving is going on. This is their measure, how much foreigners are saving in dollars. So borrowing in the saving in dollars in Peru. And this is our measure, how much residents are borrowing in dollars, and this is the measure of how much foreigners are borrowing in dollars from Peru.
But, so the second one includes the sovereign you're finding?
We subtract sovereign. We subtract sovereign. And reserves. We subtract dollar. We subtract foreign currency borrowing by governments and reserves. And then, using Larry's method, we divide this is our within country insurance. We divide by total borrowing. This is across insurance. We divide it again by total dollar borrowing. And then this is the within foreigner insurance. So there could be a lot of foreigner assets and a lot of foreign liabilities that could cancel each other. For Peru and Turkey, we do this. So this is, the green line is within foreigner, super large. So which means that foreigners have a lot of gross position in Peru, but they tend to net each other out. At the same time, within domestic, and they also have large, they tend to cancel out, and the across is tiny. Again, for Turkey, it's a little bit larger, but again, tiny. And we didn't realize this at first, but there is a miracle happening here. So these are coming from, this is our measure, and this is their measure, totally different data. So there is no ex ante reason they should add up to 1, but they sort of add up to 1. Which gave us some confidence that it could be that we are making 2 mistakes that cancel each other, but at least I guess we are sort of measuring things correctly. So our argument is that some people, ordinary households, they want to get business cycle insurance by saving in a foreign currency. And then some other residents, mostly non-financial firms, they are borrowing in dollars. Essentially, they are providing business cycle insurance to households or other residents. So then you could say that, okay, maybe when there's a depreciation, there might be losers, winners, but on average, it looks like, it's like we are allocating risk among people. It should be efficient. But we need to also consider the possibilities that this dollarization could be destabilizing.
Say that the possible dollarization is Pareto improving. I think those first bullets also apply in popular Arizona, and I'm not so sure the good Libra are Pareto improving.
I don't know.
It's voluntary trade between two people. If they do it, they're better off.
No, but the one there are two equilibria, right? One where there's a possible dollarization, and one there is not. And that would be just two equilibria,
We're
it's
gonna
not really a
address
one
that.
is better than the other.
Who's going to talk about their model?
Yeah, a little bit. But it could be that, like,
No,
this.
it's just reading the slide. It says the possible dollarization is Pareto improving.
He's going to talk about that.
But in their model, their interpretation is that people are fear that they fear that financial frictions are going to bind, economy is going down the drain, so they dollarize, which actually creates the bad environment.
Then it will be welfare reducing if it destabilizes.
Yeah, let's see.
We're going to argue it doesn't destabilize.
So but we know that, I mean, we show that banks don't have mismatch, but it could happen that firms, they owe banks a lot of dollars, and when exchange depreciate in a recession, well, they don't have money anymore, so they might go bankrupt, and then which might make bank go into trouble. So we need to address that. So we collect data from Levin and Valencia systemic banking crisis. And we look at the relationship between dollarization and frequency and intensity of crises. So we have logit regressions. We follow Levy-Yayati, Schuler-Taylor, Gorinchas-Obstfeld. And it's the same type of regressions, except that we focus on this dollar dummy. So we want to interpret this coefficient as a dummy, like if you are dollarized versus non-dollarized, but in the paper we try with other measures like continuous measures, 10% cutoff, 40% cutoff. And let me show you our results. So these are unconditional averages. And this is our logit regression. And the dollar is never significant coefficient. And we also interact with exchange rate. There is some significance, but it goes away. But we find VIX is highly significant on our regression. So like when there's a global turmoil, countries are likely to go into trouble. Also, if you have a lot of foreign liabilities in the banking system, this is the measure Levy-Yayati also uses. Also external debt, these are also highly correlated.
So you have a global financial crisis in the middle. I assume you do the business without.
Yes. We also try different measures of VIX instead of use other measures.
What is happening in time?
To 95, 2018. Or sorry, 95, 2017. So, but this coefficient, not significant, doesn't mean that dollarization is a bad predictor. And then we use a little bit more into it. We use this receiver operating characteristic measure machine learning literature uses. So I don't want to go into detail, but I want to show you the picture. So if the solid line is close to the dashed line, then it's a really bad predictor. Because the worst you could do is this 45-degree line. Only dollarization and exchange rate doesn't get you any predictability, and the p-value is 16%. But then when we add VIX and dollar liabilities, we get a lot of good prediction. This is a good number. So our model is sort of good model in that sense. And then we add everything, and then we remove dollarization, and the predictability doesn't change. So our conclusion is that dollarization does not help us in either way predict banking crises. But we find that following Gorinchas and Obstfeld, if you have a lot of dollar debt, fine, it's dangerous. If there's global turmoil, you're also likely to go into trouble.
I was just going to say one reason for that alternative thing is that the loaded percent on the asymptotic
So then actually our intra-country measure is actually then will be understated. There will be more insurance than what we see. But of course, another trap would be that even if banks are fine, firms might go into trouble, and they might not invest more. And we look at first Peru for the largest firms. We have quarterly data, and we look at Armenia. I just want you to show one other result using Peru data. We do some kind of stress test. We don't find strong balance sheet effects. It doesn't seem like if you have a lot of dollar liabilities and as a firm and exchange rate depreciate, doesn't look like you invest less. Except for Armenia, if you have high leverage and you are dollarized, you tend to decrease your investment, but otherwise we don't find any significant result. What would be the reason? And we do this stress test analysis. So for Peru, we have the balance sheet of these firms. We know how much dollar assets they have, how much dollar liabilities they have. We also see their derivatives, which is not very large, but we see. So what we can do is to have a counterfactual exchange rate, like what happens if there's 50% depreciation, what happens to the equity of each firm. And if the equity is wiped out, we say, okay, this firm is bankrupt. Then we move the depreciation.
So you may want to see the paper by Michaeledis that does an analysis for Hungary, and what she finds is that it is the large firms that borrow in dollar, so it is the most productive firms that borrow in dollar, and there might be some internal hedging.
Yeah.
Those are the ones that take it.
She presented in Mannheim, actually. I know the paper. And I also work with Turkish data. I find the same thing. It's the largest firms who borrow in dollars.
Dollar borrowing is a large firm.
And this is our stress test. So like we look at like 100% depreciation. 2% of firms go bankrupt. 200% depreciation, 10% of firms bankrupt. Why? Because, they're not very leveraged. That's the reason. They're not leveraged. So let me move to the model.
That's where the difference comes in.
So in our model, it's a very simple model, 2 periods. First period saving, and the second period is consumption. We have 3 agents, households, firms, and foreigners. And all agents have the same utility function, but they have different sources of income, so they want to hedge each other. 2 goods, home good, foreign good, 2 assets, dollar asset, peso asset. Simple model. I have this. So financial system households can save in dollars. They are going to be net savers. Firms are going to be net borrowers. And foreign financiers, they can do whatever they want. Households are endowed with some home goods, which they are going to allocate between dollar and peso assets. And they have mean variance preferences, which gives us a very nice formulation of their dollar demand, which is like there is a speculative motive, which is like a risk-adjusted expected return, and there is this hedging motive that you would like to focus on. And that depends the covariance of the returns, dollar returns, with their wage income. And if this covariance is negative, which is going to be the case, they would like to hold more dollars. Firms are the same, except that they borrow, and the borrowing, they have the same preferences, and they have a very similar formulation. This is dollar borrowing by firms. So they look at the return with their sign reversed, of course. They want to borrow from the cheaper source, but they don't want to borrow in dollars because whenever dollar appreciates, their return to capital is going to be low. So they would like to be averse to borrow in dollars. Foreigners, they can borrow and lend in dollars without any friction. There's no risk involved. There's no default. But when they are saving in pesos, they are going to have the same formulation. There's going to be a speculative motive. They are going to look at risk-adjusted returns. Also, they are going to have a hedging motive, and there is going to be this exogenous income of the foreigners that is going to be correlated with the local exchange rate, which captures this global financial cycle idea. So whenever US is in trouble, if S&P 500 goes down, Peruvian exchange rate depreciates. So if you are invested in Peru as an American, you lose in both sides. And if this covariance is large, foreigners will not want to invest in peso assets. Equilibrium, I mean, there's balance of payments, final consumption. Shocks are, there's going to be an export demand shock, like how much foreigners would like Peruvian asset, which is going to be correlated with the exogenous foreigners' income. And we have a productivity shock, and this S is going to be the covariance. In our model, for the case where B star, dollar borrowing, is close to D star, we have the very nice analytical expression of interest rate spread, which is directly related to this covariance term, risk premium. So we calibrate this model to Peru. And one exercise I would like to show you is that this hedging motive by foreigners is actually very important. So this is again the foreigners' position, and this is their covariance with their exogenous income and the export demand shock, which is going to make exchange rate correlated with their exogenous income. So what we do is that this model is calibrated to Peru to have 2% spread. We are going to just set it equal to 0. What will happen? What happens is that spread goes down, and we see large lending in local currency to domestic borrowers. At the same time, we see large increase in dollarization. So what happens is that firms, they don't borrow in dollars, they borrow in pesos from foreigners. Households, they save a lot in dollars, and foreigners are actually intermediate. So it looks like the foreigners, the across term, will dominate. But then fine, we do another exercise. We are going to set S equal to 0, but again target the spread by changing foreigner risk aversion, which was equal to the agent's risk aversion. So there we see that, I mean, in order to see observed spreads in the data, we require like super large risk aversion by foreigners, which is counterfactual.
So when you say large increase in dollarization, insurance provided by foreigners, that means what? That the households of firms are saving in dollars?
Everyone is saving in dollars,
Yeah.
and foreigners are lending in pesos. So foreigners take the exchange rate risk. Because their covariance is 0, they don't care. Yeah. But then we could, again, target the observed spread by changing the risk aversion. But then we will require huge risk aversion, which is, I don't think it's crazy. And then last exercise is that we just say, okay, there's no dollarization. Households cannot save in dollars. And what we see is that spread goes down, so households are worse off because they cannot get insurance. Firms, they get cheap funding, but then exchange rate becomes more volatile, so firms also lose. So it's only foreigners who gain from preventing dollarization. Because now they can get actually, I mean, there's something counterfactual happens, they get business cycle insurance from Peruvians. So our concluding observation is that one caveat is that our empirical results mostly coming from 2000 with like good, maybe you could say, regulatory environment. So, our results are conditional on 2000 regulatory environment. So, I guess it's a good idea to have no currency mismatch in banks. So, we are not saying that you could just release all the regulations, but conditional on the current regulation, it looks like dollarization does not pose a systemic risk, and it looks like it provides income insurance to residents. Thank you very much.
You have. Okay, thanks very much for the invitation to read the paper. I should say I started reading the paper, an NBR working paper, which is dated July 2021. And then the end of last week, Husnu sent me the current version of the paper, which is 135 pages. Okay? So as you can imagine, there's a lot of stuff in there. So I decided not to go through all the details in there because there's a lot of details in there, and it's a very. Sorry, it's 135 pages. So there's a lot of a big online appendix, okay, with lots of stuff, lots of footnotes, as you said, but it's a lot more than footnotes. So I'm going to put it a bit in a perspective of the conference, which is emerging markets. So a big part of my time now, I do household finance research, household portfolio choice, and the data that we use, that is being used in that literature, is heavily slanted towards certain Scandinavian countries, Norway, Denmark, Sweden, which are interesting and important, but they hardly generalize because they don't really hold many dollars in their account. So these issues never come up. And I cannot think of a single paper that does this from the micro up, actually. So instead of from the macro down. So in that sense, this is quite important given the prominent role of the dollar in international transactions. So that's kind of a very important issue under research, and hopefully more papers will come up from the micro up, actually, because there's no understanding of what generates this and how it happens, how it arises, who participates, who doesn't participate, how much of your wealth you put in there. So there's like a black box. So that's kind of a caveat to show that this is important, basically, especially given the macro literature, international macro literature, and the prominent role of the dollar in international transactions. Now, that's one thing. The other thing is many papers focus on the banking system borrowing in dollars, which is the classic currency mismatch. This paper instead focuses on households and on the risk-sharing properties of the United States dollar within different countries, basically. So it's a kind of an intra-insurance. And the intuition is quite simple. As a household, you want to invest in the dollar. The dollar appreciates when the emerging market goes into a recession, and the agents holding the USD in that country are essentially covered. They're insured, and that's why they have demand for this dollar, even though they don't earn a high rate of return on it. So the local rate of return is typically higher than the deposit rate that you get from the dollar, and this is the price of this insurance if you are willing to take it. So that's kind of a nice, intuitive story. Now, now there's a dollarization variable which is defined across 140 countries. It's actually defined as the value of the foreign currency deposits held by domestic residents in domestic banks over total deposits. And the key result is that for more, so there's a very nice figure in the paper, that for more dollarized economies, the exchange rate depreciates more in recessions. So if you're a holder of that asset in a recession in a country as a household, then you're insured. You can continue consuming the basket that you have. So, and I'm going to come back to this because one of the key points I want to make is that going back to my Lebanon presentation, this is, I'm still struggling, and I want to actually hear your views on whether it fits the story or not, because there's conflicting evidence, actually. Sometimes it does, sometimes it doesn't. I'm going to come back to that. So the next big question is who provides this insurance? And as we heard, the answer is the firms, basically. So the firms are borrowing. So that's kind of in the dollar. Now, the next big question is dollarization destabilizing? So in terms of frequency of banking crisis and intensity of the crisis, so once you go into a crisis, and there is no systematic evidence that there is a relationship. And then there's a two-period model to further enhance the intuition. Now, I should say this could have been two papers in one. Two papers because this is kind of, even though it's a two-period model, it's actually a mean variance investor firm foreigner put together in a general equilibrium setting. Even that can get quite complex quite quickly, actually, when you calibrate it and when you try to. So this could have been, going back to Javier's presentation, if you want to do more quantitative work, this could be a paper on its own, actually. I'm assuming the reason it's not 2 papers is because you don't have the perfect identification, like in the first part, in the empirical part. But the question is very important, so it's, that could have been an approach, but that's done for now. Now, there's 2 main comments I have, which relate a bit to this Lebanese experience, because I'm still struggling to understand. So I have the, so before I go to those 2 comments, when you do those absolute differences between deposits and credit in terms of foreign currency, it's not actually automatically obvious where this intra-insurance is coming. It would be good to provide some, you have it in different parts of the paper. It could be in other papers, but it would be good to understand better what those absolute differences are. It's not obvious actually how they follow from the market clearing, actually. So, so just say, it could be another footnote, but it's a simple footnote to write. Now, because I'm going to come back to using those calculations. Now, neither in the model nor in the data contain huge disasters like the one I described in Lebanon, where you have, which is a very common experience, actually, where you have the currency go from 1,500 to 15,000 or 35,000 to the dollar. Now, and the reason, so now you could try to just condition, now you have a theory. So a theory is supposed to capture all states of the world, but I think that's a bit too ambitious for economics, I think, because there's always different things that happen in different countries. So it would be good to condition on various things that happen. So do we ignore these disasters? Are they completely unexpected, or should we have them in the model or not? How do we think about them? And the reason I say that is because a lot of Lebanese households are actually do what you are saying, actually. As long as this is happening and the exchange rate is kind of, I think they hold a lot of dollars. It's a heavily dollarized economy, actually. It's 60% of GDP is held in dollars. USD is an official tender, legal tender. 60% of GDP is in dollars. So there's a huge dollarization in the economy. And part of it is, I think, driven by your intuition. The problem is, this intuition fails. I mean, there is a huge crisis. So on one hand, it's consistent with your intuition. On the other hand, there's a huge crisis. And that's inconsistent with your other. So maybe it's one counterfactual. It's one observation, but still.
You, in your discussion
yeah.
yesterday, which was very interesting,
Yes.
you never mentioned dollarization as being a cause. You mentioned religious tensions.
No. Well, no.
Different things. The government got a big deficit, and we agree all those things can give rise to crisis.
So it's a highly dollarized economy. In that economy, so I'm going to say something now that is not in your model. Now, you can argue, and the question is, and I don't think a model should explain everything, all different possibilities. I mean, we can have a philosophical discussion about that, okay? So in this particular case, banks, and if you compute your numbers that I have here, the number that you said, less than 1, is between 2 and 4, and goes to 8 in Lebanon. Okay, so it's the opposite. So banks were depositing US dollars with the central bank, and that was perceived as safe. So these guys, the firms, the banks and the firms actually, in this case the banks, were actually taking these dollars that they were getting from abroad, and they were putting them at the central bank, and the central bank was doing its thing to support the exchange rate. They go back to the Krugman, to support a very strong exchange rate. Now, and eventually it blew up. And there was a huge crisis. Now, okay, so this possibility is not in the model and not in the data, and I would not have expected either the model or the data to actually have this weird case, okay? But it is a case, and it does exist. And at some level, it has your intuition, actually, but then it has a huge crisis. So, which could have been, history could have been written differently, and could have been avoided, but it did happen. So, and it's not obvious to me how to think about it. Then, and one thing that is missing from the model, which is more substantial relative to a rare disaster view of the world, is what is the role of the central bank in the model and in the data. So this is absent from the model, whereas we know that the central bank is a key player in many of these countries. What is happening right now in Lebanon, but also in Egypt, in Pakistan, in Turkey, the central bank is a major player. Now, we can ignore it, but the question is, how do we think of that in terms of politics and in terms of economics? And I think that's a separate paper. It's not part of this paper, but I'm putting it out there because potentially this might be an important issue. So, I mean, and I don't know whether one way to get around it is to think of the model as being kind of around a steady state, and you can go from 25% up or down, and that's kind of around a steady state, but not near a dramatic disaster, or whether when you go away from this, or whether it's multiple equilibria, whichever way you want to say, that could be interesting. For example, there's a recent nice paper by these guys where they say central banks, for example, care about their profits, and these become important when defending a peg. These central banks, essentially, they have a very nice graph in this paper where the way they identify that central bankers care about their profits is by looking at the discontinuity of the profits at 0, and they show that distribution is to the right. So very few central banks declare negative profits. So this could be, if you're in an economy like the one you're describing, the central bank could have something to say. Now, I think this is fascinating, actually, the results. From the micro up, there's no evidence on this. From the macro down, we could argue, I think this is the only thing that I have seen, so this is very interesting. There is a recent book, actually, by Kijo and Nicolini on the experience of Latin American countries. I think potentially this could be related to that, and then this could be emphasis on the future, basically, because 135 pages, I wouldn't want to touch much, okay? So a few footnotes, and that's okay. But yeah, it's a very good paper.
You want to answer?
Well, first of all, thanks, Alex, for a very kind discussion. And in the morning, we were talking with Alex, and he said, this paper is 135 pages. And I said, because every discussant asks us to address some issue. So there are a couple more footnotes to add now. And for Lebanon, and I guess for Turkey, this is, I once admit something that we never thought of. Our measure was that we said, okay, banking system does not have any mismatch, but we never thought about central bank having a mismatch. So, yeah, I agree. This is something that, and I guess in Lebanon, what looks like is that dollar deposits are much larger than dollar borrowing, right? Maybe not.
No, it's
Okay.
the other way around. So the numbers are actually completely
Okay,
the
then
opposite from what you have,
I
actually.
will be happy if you
I can
could
send
send
you.
it and we
Yeah.
can
Yeah.
easily integrate. But similarly, Atkinson and co-authors have a recent paper where they sort of touch this issue. In the last 80 years, there are like maybe 15 cases where sovereigns actually sort of had bank, they one way or another not allowed depositors to take their money back from the banks. And these are almost all, 99% of this is related to sovereign default episodes. So whenever a sovereign is in trouble, dollar accounts of people is unfortunately a good source to go. And then what happens is that people either have offshore accounts or they have dollar under the mattresses. So this is something that happens very rarely, but it happens nevertheless. And actually we discussed that as another footnote. Thank you, and looking forward to questions.
Maybe I did get, but I just want to find out when the households are holding the foreign currency, when they buy the foreign currency and that is some kind of trouble, how do they liquidate it? Do they convert it to the domestic currency, or do they just go straight in and buy assets? And if they convert the money to domestic currency, does it have an effect on the money supply?
So like 5 years ago, my dad was telling me that converted everything in dollars so that when there is a housing crash, he's going to buy another house. So that is how it happens. Like whenever the economy is in trouble, asset prices go down, economy goes down, and then your dollar accounts go up. So you could just sell your dollars and then buy more consumption good or more assets in a cheap.
Jamari.
So, very interesting paper. Done work on how net currency positions matter for price probabilities as well, and they do matter a lot. With Lebanon, the country as a whole was short FX. Households were long FX, but the country as a whole was short FX. So obviously, if a peg gives way in a country that is short FX big time, your dollar deposits are not going to be live somewhere. So I think the issue is really whether countries are debtors or creditors in the aggregate in FX, whether the and the central bank
Yeah.
dollar deposits, but its reserves were way below the amount of dollar.
Is that consistent with what we were saying?
Yeah.
We said that there are two things.
No, I'm
We
saying
said two things are important for crises. A large foreign debt and the VIX.
no, absolutely. But so the evidence we have is that work with Discussant, we published 5 or 6 years ago. The GI is similar to the Mauritius Hospital, but it shows that what matters is the net debt position of the country rather than the net IFD. So, the net FDI and equity position does not matter that much. What matters is mostly the net debt position, and that's most likely, in my mind, a proxy for currency exposure. Because in the sample, and here's you're considering countries that are net debtors as a whole are net debtors in FX.
Okay, but so we find that
Yeah.
borrowing can get you into trouble.
No, it is
Whether
very
you
difficult to
dollarize or
find. The question was,
You need to put both.
In fact,
When you
when
put both,
you
you find
include
out
that-
it's stuff.
When you include that, you don't get any
Yeah.
extra information from the dollarization. So I think we totally agree.
yeah.
If you borrow too much, you're probably going to be, I was going to say something. If you borrow too much, you could be in trouble. And that's one of the two main things that predict trouble is borrowing too much abroad and whatever you borrow. But if the conditional on borrowing abroad, again, deposit dollarization does not contribute to the probability of crisis. The borrowing per se does.
But still, the last thing there is that, okay, suppose you're saying only total debt matters, but now suppose all the debt is in local currency. Now the exchange rate doubles, so the debt in real terms
Okay, this is,
goes back.
I'm just saying, when we look at the regressions, okay, the regressions understand all these things. They're saying the marginal contribution to the probability of a crisis, given that I know what the external debt is zero. That's what they're saying.
Yeah.
Is there a way of relating this to original sin?
What?
Is there a way of relating this to original sins? I mean, there was a time when we thought the big issue is these countries are borrowing in foreign currency and are unable to borrow in their own currency. And that creates a mismatch. And that leads to crisis.
No, wait.
But it's the timing he has. The timing he has, the original sin by its sovereigns has gone down.
Yeah.
And the other thing that is not exploding with another devaluation is the bank. The bank is fine. So you may have firms go bankrupt, but it's not
So
blowing
can
up.
I say something?
Yeah, maybe.
I understand.
I want to add one thing to what you said. So the banks are highly leveraged.
Yes. But
15. And so in another paper that we know about, the banks and the firms are merged. And the leverage is kind of what both of them is. But there's a selection going on in the data that we looked at. and it's the low leverage people that are borrowing. And the banks don't have any mismatch. Now, that's a little bit of a lie, because actually, I'd like to correct that. The IMF data don't fully get it, I think, right, in the sense that you can, on the books, look like you have no mismatch. But if there's a term mismatch, it can turn into a currency mismatch in a minute. Now, good bank regulators, I think they pay attention.
So Brazil, Mexico, Chile, they check all those things every day. And by the way, they're also not that dumb. They do know that if you're lending to a lot of firms that are super exposed to exchange rate, even though you don't have the currency mismatch, you need to put more macroprudential, you need to buffer up in equity.
Yeah, and an example of this is Eastern Europe, an example of where you can go wrong. So in Eastern Europe, they were lending this money, Swiss, there the dollars were Swiss francs, and people who, first of all, people who buy houses are typically highly leveraged when they do that, but they also had zero experience with this stuff. We went through the banks, and now the banks aren't allowed to, now they Hungary, Romania, Poland, they've all shut down.
So I'm fine with, let's regulate banks well, and let's not have currency mismatches and do the complicated capital requirements to things, because that helps us avoid the country exploding. What I think is, I'm not so comfortable with your next step. Conditional on that, let's do more deposit dollarization, because that's good.
No, we allow people to decide for themselves if they want to do it. So in the model, for example, people voluntarily participate in these markets as a form of insurance. By the way, this is all isomorphic to futures markets, right? And we normally think that literally mathematically identically the same as futures markets, these dollar deposits. And when we think about commodity markets, we think quite casually about them as being ways of reallocating risk. And you can think of that in the same way when you think about dollars.
I know, but there's something that I still think is good if we get countries to go back to their local currency, that somehow is not math. And I need to think about that.
One of the things that people say that's not good is that it interferes with the ability, too much dollarization interferes with the ability to conduct monetary policy. And we do want to give, obviously, if you're completely dollarized and you're changing the quantity of soles in your economy, no one's going to notice. Okay, so that is one thing that we would like
It's
to look
also
at.
the dollar was 10.
Can I say
Yes,
something?
yes, please.
Sorry, I
Tell-
just last.
Maybe we want to hear from you.
Refet was asking about original sin. So this is our original sin. According to our model, foreigners do not want to invest in local assets. Well, first of all, they are risk averse, fine, but mostly because they think that whenever the US goes down, the local currency is also going to depreciate. So the thinking is that these small open economies are very sensitive to global financial cycle. That's why international investors, they don't want to invest in local currency assets. So this S is our original, this is how we microfound originals in our model.
Perfect. Can I ask you to conclude the proceeding?
So this was great. The ERSA weren't here, many of the ERSA weren't here either, but as you know, conferences are only as good as the local organizers, and these were wonderful. So we evolved into our Southampton office, and I have to say, it was great. It's not always that conferences go here this way, and people actually like to talk to each other.
Right, at least they pretend.
There's a lot of cases where
It's a miracle.
we're face to face, but it feels online. This wasn't one of those. And so thank you all of you for being here and being present. Take care. So it was wonderful, and hopefully it's going to be first of many.
Thank you.
So good luck
Thank you
with
very
the
much.
paper.
Can you